here's an example. So here, if you look at this graph, okay, and this green line is SML, security market line, okay, and that means the horizontal axis has beta, the systematic risk, or market risk, and considering the risk, we can calculate the required rate of return. That's what we did last class. And if you remember the discussion from last semester, actually, when we discussed the CAPM, capital asset pricing model first time, you probably remember that any projects or any investment above this green line, above the security market line, are acceptable projects, right? And any investment that are below the security market line are not acceptable, right? Unacceptable, right? And if you think about it, the reason is very obvious, because, well, what that, security market line defines the required rate of return considering the market return, right? Okay. So if you have certain level of beta, let's say 1.5, okay, and for this particular investment or stock which has market risk of 1.5 in beta, we can calculate the required rate of return, right? Let's say that comes out to be 3.5% annual return, right? So if any investment is something like that, right? It has 1.5 beta, but the rate of return is below 3.5, right? Then that is considered inadequate. The rate of return is not high enough, okay, to compensate for the risk, right? So any investment below the security market line should not be accepted, right? So yeah, that's the idea, right? So what this graph is telling us is that if you consider just the weighted average cost of capital, WACC, okay? Again, we have not formally discussed this WACC yet. We'll do that in chapter 12, I think, right? Cost of capital. But this is just you can consider the average cost of capital, right? Because in capital, when we say capital, we can think about the stocks or equity, debt, typically equity and debt, but some part of equity also is preferred stock. Okay? So in our textbook, we tend to separate the preferred stock separately, right? So for discussion purpose, we normally talk about three separate types of capital. Okay? So when you are interested in any new project, right, the question is how do you raise the fund? Okay? And then when you raise the fund either using equity or debt or preferred stock, what is the cost? Yeah? In other words, what interest do you have to pay, interest payments you have to make on those type of capital, right? WACC, weighted average cost of capital, is simply weighted average of the cost of each individual type of capital. Okay? So we'll talk about that in full discussion in chapter 12. Okay? But anyway, so if the company just uses WACC to evaluate any project, suppose the company's weighted average cost of capital was 3%. Okay? On average, they pay 3% cost on stocks and bonds and the preferred stock they issue, right? then they can use the 3% to discount the future cash flow, right, of any project and calculate net present value. And if the net present value comes out to be positive, you will accept the project. If it's negative, you will reject the project, and so on, right? That's what this, the red dotted line is talking about, right? So if you use just one single WACC to evaluate any project, right? And according to that rule, project 1 and 2 will be rejected because their rate of returns are below this WACC, right? And the project 3 and 4 will be accepted, right? Because their rate of returns are above this red dotted line, which is WACC, right? Do you understand that idea? Yeah? But if you consider risk, right? If you consider risk into your evaluation of the project and use this security market line concept, right? Then the 1 and 3, projects 1 and 3 should be accepted, right? And 2 and 4 should be rejected. Right? So the point is, depending on what criterion you use, right? You will either accept or reject the projects in different way. Your decision will be different. Which one should you prefer? WACC approach or RADR approach? Risk-adjusted discount rate approach. I would say RADR is better because risk is certainly an important component, important factor or aspect of any project, right? So the discount rate should be adjusted considering the risk involved in different projects. Don't you think? Okay. All right, so that's it for chapter 11. Any question? All right. My plan is finishing chapter 12 by next Tuesday. So today, this Thursday, and next Tuesday, we're going to talk about chapter 12. And the Thursday next week, we're going to have a review session, right? Because that's the last class before the midterm exam. Okay? So I want you to try some problems until then. In chapter 10, problems 11, 14. In chapter 11, 8, 11, 12, 17, 22. Yeah? You don't have to hand them in. Just try these problems yourself, so that we'll, I guess, bring your question to the review session. If nobody asks any question, then I may not go over this problem. I just take it as a sign that everybody understands it perfectly, right? All right, so starting from chapter 9, I guess, right? So from the beginning of this semester, we've been talking about capital budgeting, okay? And again, the capital budgeting is about the investment, right? Investment in different projects. What kind of projects are there, and how do you evaluate the projects, and so on, right? And you know, one of the important components in all this analysis was discount rate, because in essence, what we are doing is in any project we expect future cash flows, okay? And to evaluate the today's value or present value of those future cash flows, we had to discount, right, those future cash flows, right? The question is, what rate do you use as a discount rate, right? Simple answer was the market interest rate, okay, in the typical situation, because we're talking about the opportunity cost of the money. Okay? When you are using money, right, then you are giving up the opportunity to earn interest in the market, right? So what that means is in whatever project you invest your money to, right, you have to earn at least as much as the market interest rate. Do you understand that concept, right? Right? Well, but now we are trying to refine that analysis and try to make our analysis a little more sophisticated, okay, and more professional, technical, right? So, as I mentioned already, yeah, in a normal, typical company situation, in order to invest in a new project, they will need more money, right? So they will have to come up with new capital, right? And there are a few ways they can raise capital. Equity financing means selling stocks, okay? Debt financing means selling bonds, okay? And so on, right? Or they can issue preferred stock. Okay? The question is, when they issue these securities, either bonds or stocks or preferred stock, whatever, right? What is the cost to the company? Okay? That's the topic of this chapter, chapter 12. Okay? All right. So cost of capital is the rate of return required by investors in the firm's securities. Well, this is a slightly different definition from what I've just mentioned, right? I told you that the cost of capital refers to the cost to the company when they issue new securities, right? And how that is the same thing as this one? Well, if you want to sell bond, let's say, suppose your company decided to issue some new bonds to raise more capital, right? Then the first thing you have to decide is, well, how much and at what rate. Okay? So in reality, your company will contact a investment banking company, investment banker, right? And tell them that, well, we are going to start a new project and we expect to use about $500 million. Okay? So what's the best way to raise this amount of money? Right? Then the investment banker will give you an advice, right? Considering the economic situation and interest rate and whatever interest, the market situation right now, right? The best way is to maybe issuing some bonds. Well, sometimes they offer some combination, right? Maybe $300 million in bonds and $200 million in equity, right? Selling stocks, okay? Something like that, right? And they will also advise that at this point, if you want to sell your company's bond, what that means is considering your own capital structure. What is the capital structure? I think I mentioned it last class. What do we mean by capital structure? That's right. Debt equity ratio is simply, right? Debt equity ratio. We use B for debt because I guess B stands for bonds, right? All right. So considering, how much, basically what the investment banker is telling you is considering how much debt you have already accumulated, right? You have to offer at least certain interest rate, right, on your bond, so that the investors will be interested in purchasing your company's bond, right? So that's what we're talking about here, right? It's the rate of return required by investors in the firm's securities. Okay? Rate of return, right? So if you want to sell $300 million worth of your bond, say you have to offer at least 5% annual rate, right? Otherwise, investors will not buy, or not enough investors will buy your bonds, right? Which means you won't be able to raise your target level of $300 million right? New capital, right? What about stocks? Can you apply the same idea to stocks in case you decided to go for equity financing, right? You want to raise $200 million in stocks, right? There's no such thing as interest rate on stocks, right? So what do we mean by required rate of return on the firm's security in case of stocks? What are we talking about? That's right. Required rate of return, how do investors get return on, the stocks, right? Well, we're talking about dividends, right? What dividend you're going to pay, right? And also the selling price, okay? If you really set the price at high level, right? That reduces the rate of return to investors, right? So you may not be able to sell enough stocks, right? So you have to adjust those things. Right? Yeah. So cost of capital, remember, we're talking about the rate of return required by investors in the firm's securities. Yeah? Weighted cost of capital or weighted average cost of capital, WACC, right, is typically what we say. Right? And this is the discount rate used when computing the net present value of a project of average risk. Okay. So the idea is when a company has WACC, yeah, company is going to use this rate, cost of capital, to evaluate all the projects that they are considering, right? So the problem is some projects are riskier than others, right? But, well, if you're going to use the same interest rate or discount rate to evaluate all the projects, right? What that means is this rate has to be for the average risk projects. Okay? That's what this statement means. Okay? So when the company has multiple projects, right? And the thing is they're going to use one single discount rate to evaluate all the projects, right? So it better be the right interest rate for the average risk project. Okay? Or you can say that it's the hurdle rate used in conjunction with the IRR approach to project evaluation. Right? What is the IRR approach? Internal rate of return approach, right? So how do you evaluate a project using IRR? What is the criterion? What's the method? Well, you're going to calculate internal rate of return, right, using the future cash flow. And of course, yeah, it's different from net present value, just to refresh your memory, right? Net present value approach uses discount rate to discount the future cash flow, right? And compare that discount in the future cash flow to the initial investment. And if the discount in the future cash flow is greater than initial investment, you're going to accept it, right? IRR does not discount the future cash flow because you don't know the interest rate, right? you're trying to determine that interest rate. That's the internal rate of return, right? So how do you calculate the internal rate of return, right? Well, you compare to the initial investment to the future cash flow, and you solve, okay. Try to 1 plus KDA summation. I goes from 1 to N, and I. Okay, this is got to be either I or CF, NCF, right? And M1 plus KD. So this is I, this is N. Yeah. So think about the typical bond situation, bond formula, right? If you pay certain amount to purchase the bond, right? Then the same thing, right? Initial investment, right? Every period you receive interest payment. In the case of projects, you receive net cash flow, right? And you are discounting either interest payment or net cash flow using certain interest rate, right? And may make a summation of all those discounted future cash flows. And then in the case of bond, there is one lump sum payment, right? And you discount it for N year and so on, right? Well, so if you use discount rate, then you can calculate the net present value, right? By subtracting NI and B from this left-hand side from right-hand side, right? But the IRR approach is trying to determine this discount rate, which makes left-hand side equal to the right-hand side. Okay, remember that? Okay. So let's say IRR came to be 6%, right? You calculated IRR as 6%. Then how do you use that IRR to make the decision? Accept the project if what's bigger than? Well, no, this is your return, right? Internal rate of return. You're earning 6% return on this project, right? So accept that project if that's right. If this is greater than the cost of capital, cost of money you use, right? Or cost of basically the market interest rate. That was the idea, right? If IRR, rate of return, is greater than the cost you pay, that means you're making profit, right? If the cost is 7%, and you are earning only 6% return, obviously you should not accept that project, right? That makes sense, right? Okay? So here, all right. It's a hurdle rate when you use IRR approach. Okay? So what we mean by hurdle rate, right? If you come up with the internal rate of return, right, the cost of capital has to be lower than that. In other words, this IRR has to exceed that cost of capital. Okay? Cost of capital has to be low enough in order to accept that project. Okay? Okay. And exactly how do we calculate the WACC? Right? KA is the weighted cost of capital, okay? And the BEP all stand for the market value of different types of capital. B stands for bond, which is debt, okay? E stands for equity, and P stands for preferred stock. Okay? Normally, preferred stock is pretty small component of any company's capital structure, right? Okay, and so many times we simply include the preferred stock into equity, right? And just calculate the debt-equity ratio, right? Now, perhaps I should make a restatement there. Right? The preferred stock is, even though the name is stock, in many senses it's similar to bond. Right? So actually when they calculate debt-equity ratio, for all the purposes or practical purposes, preferred stock should be included in the debt portion. Okay, we'll talk about that as it comes around. Okay. All right, so if you look at the first component here, equity divided by B plus E plus P. What is B plus E plus P? What can you say? Huh? B plus E plus P. What can you say? What is that? Asset or total capital. Total capital, right? So the denominator here, total capital, right? And the equity divided by total capital, well, so that's simply the proportion of equity in their total capital, the company's total capital. Here's the proportion of debt in their total capital, proportion of preferred stock, right? And we multiply those proportions by the cost of capital, cost of each component, okay? So cost of equity capital times the proportion, right? Cost of debt capital times the proportion. Here we multiply 1 minus t. What is 1 minus t? Tax rate, right? 1 minus tax rate. Why do we do that? Huh? Okay. Right. Tax, right? In other words, debt payments or payment on debt, interest payments on debt, right, are tax deductible, right? You can remove or subtract, right, that amount, the amount of money you use to pay the debt, pay the interest on the debt, right? So if the tax rate, for example, is 40%, right, then the cost of debt is actually only 60. If the cost of debt is 6%, right, actual cost is 6 times 0.6, which is what, 3.6%, okay? Because you're saving money from taxes, tax deduction, right? So even though you make the 6% interest payment on your debt, actually, the actual real cost is only 3.6%, right? That's what it is about. Okay? And finally, you multiply the proportion of preferred stock to the cost of preferred stock. Okay? Okay? There are a few other points, a few more points for weighted cost of capital. So when we use this formula, going back to this slide, when we use this formula, right, this amount of equity, amount of debt, amount of preferred stock, right, should we use market value of those items or book value of those components, right? if you're talking about debt, actually, right, then they may not be that different, right? Once you issue, say, $200 million bonds, right, your debt is $200 million, right? It doesn't change, whether it's in the book or market value, right? However, in terms of equity, the stocks, right, there can be big difference between the book value and the market value, right? So this is an important question, whether you should use book value or market value when you calculate the cost of capital. Okay? Well, what do you think? Market value? Why? Okay. All right. Real. Okay. Yeah. Well, again, the cost of capital is the rate of return required by investors, right? And when the investors purchase the security, whether it's bond or stock or whatever, right? What they pay is actually the market value, right? Not the book value, right? So by the amount they paid, right, the rate of return is determined on them, right? So if, suppose you issued a bond with a par value of $1,000, right? But for some reason, the price was really low in the market, so the actual investors paid only $500, right? Then when they calculate the rate of return to the investors, you have to use this actual market value rather than this par value. Par value is meaningless, right, as far as calculating the rate of return goes to the investors, right? The same thing for the stocks. Okay? Investors will calculate their rate of return by how much they paid when they purchased the stock, actually, right? So yeah, when you calculate the cost of capital, right, you have to use the market value. Okay? Also, the problem of lumpy capital. This is a little bit, well, yeah, not that complicated concept, but maybe you have to understand. Okay? What this means is, basically it means that the investment decision should be separate from financing decision. Okay? So, in reality, based on some needs, when the company tries to start new projects, they'll try to raise new capital, right? And they may raise a capital, one type of capital at different times. So for this first project, say project A, right? They will try to raise the fund using the bonds by selling the bond, right? And the thing is, the amount may not match exactly, right? So even though they expect, say, $100 million need for project A, they may try to raise $200 million capital at this time because they expect some more project in the future, right? Or they may have enough retained earning, right? Like Microsoft, right? Microsoft is known to have a lot of cash, right? Sitting on cash cushion, right? What they call, right? And so, well, they may not need a lot of money, even though this new project requires $100 million new investment. They already have $80 million in retained earning, right? So they may raise only $20 million cash, right? Or using the debt or equity, right? So the problem is, what about the next project? A, B, okay? And let's say it requires $100 million each, right? And they are equally risky. So in many senses, projects A and B are identical projects, right? But let's say the company decided to take on the project A first, okay? And they have raised enough cash or capital to fund the project A. And of course, the company uses the lowest cost fund first, right? So let's say they sold the bond and raised $100 million, right? And for the next project, are you going to sell more bond? Well, maybe. But in some cases, in typical cases, we have what they call target capital structure. Target capital structure. In other words, companies typically have target level of debt equity ratio. Okay? Because, well, if the company accumulates too much debt, then it can be regarded risky by investors, right? So in many senses, it doesn't really project good image to the market, the security analysts in the market, right? So, well, the company may say, okay, we have raised $100 million in debt. If we raise another $100 million in debt again, then we're going to get off the target level of debt equity ratio by too much, right? So unfortunately, we have to raise the next $100 million using equity, right? The thing is, the cost of equity is typically much higher than the cost of debt, right? So even though these two projects are identical, they require the same amount of money, same amount of return, and same level of risk, right? If you use this kind of approach, then you may end up accepting this project and rejecting this project because the cost of equity is much higher than the cost of debt, right? Which doesn't make sense in overall picture. If you look at the company's overall picture, right? If projects are identical in their risk level and return level, right? Then the way you raise the capital should not matter, right? In other words, the investment decision should be separate from financing decision. Okay? So from that point of view, the ideal way of making the decision is you have to use WACC, right? You have to calculate the overall average cost of capital, right? Using the target level of debt equity ratio or capital structure, right? And you have to apply the same cost of capital to all the projects, evaluating all the projects. That's what this lumpy capital refers to, right? It's a little bit complicated or lengthy way of explaining it, right? But simply said, the investment decision should be separate from financing decision. You cannot connect every project, each project to different way of financing, right? Then you may end up making very illogical investment decision. Yeah. Okay. Question? All right. So here's an example, just a simple example of so we have three components: common equity. It says internal common equity, Internal common equity means retained earning. Okay? External common equity is stocks. Okay? So we have internal common equity and debt and preferred stock. And somehow we came up with the after-tax cost of 10.4%, 4.8%, and 8.1%. Right? And capital structure or target level of capital structure is 47% equity, 51% debt, and 2% preferred stock. Okay? So you just multiply 10.4 by 0.47, you come up with 4.89. 4.8 times 0.51, okay, is 2.45. So when you add them up, we come up with the 7.5% for WACC, okay, weighted cost of capital. Okay, that's how we calculate weighted average cost of capital. Okay. The statement there, the cost of capital of the firm is equal to the equilibrium rate of return demanded by investors in the capital markets for securities with that degree of risk. What does that mean? Equilibrium rate of return? I think it's talking about this after-tax cost, 10.4%, 4.8%, 8.1%. How did we come up with those rates? Who determined those rates? Any idea? Let's say debt, for example, here. 4.8%. No, yeah. Bank. Yeah. If they borrowed money from bank, yes. But typically, the way the company raised the capital using debt is by selling bonds. Okay. So apparently, when they sold their bonds, they have offered 4.8% annual rate, right? Who decided this? Market. Yes. Well, of course, you can say, well, maybe it was suggested by investment banker, right? But then, how did investment banker came up with this 4.8%, right? Well, they considered the market in essence, right? In essence, what they came up is what's the lowest possible rate at which you can sell your bond, right? And raise enough capital that you need, right? As I used as an example, if you need to raise $300 million by selling bond, right? Then the point is, well, what's the rate? What's the lowest possible rate at which you can raise that $300 million fund, right? So what that means, if this was the equilibrium rate, 4.8%, right? What that means is if you offered any lower than that, right? Suppose you offered 4.5%, right? Then probably you couldn't sell all the securities, all the bonds that you have offered, right? And that means you were not able to raise $300 million, right? Okay? That's the idea, right? So this is the equilibrium rate or market clearing rate, equilibrium. In the old days, we used to call this equilibrium point, right? Where the demand and supply intersect, right? But typically these days we prefer market clearing level of price. because equilibrium is not really an exact or accurate term, right? Because what is equilibrium? Equilibrium seems to give the impression that everything's perfect. If you're in equilibrium, right? Everything's fine, everything's perfect, right? But that's not what this point is about, right? Nothing is fine. The price could be extremely high or extremely low, right? And it depends on, individual perspective. If you're a consumer, price is always too high. Right? If you're a seller, price is always too low, right? In the old days, we used to use the concept or definition of equilibrium that they use in physics. Okay? And in physics or natural science, equilibrium means the system is in stable condition, no further change, right? So no further change. So we used to use this example. If you drop a golf ball inside the bowl, right? For a while it's going to move back and forth, but eventually it's going to come to a lowest energy point and stay there. Unless somebody shakes this bowl, right? It's going to stay there, right? So no further change. That's the concept of equilibrium that we used to teach that way in economics, right? But if you think about it, price changes constantly. In market, do we really see equilibrium price? Think about the stock market, right? Stock price changes every second, right? And so there is actually no equilibrium. Or you can say this is a continuum of equilibrium, right? So equilibrium, you have new equilibrium every second, right? So yeah, I think that these days we prefer the term market clearing level, right? Market clearing price. Okay? So what this means is if you offer the rate too high, too low, right? Then you won't be able to sell all your securities, which means market is not cleared. Okay? So 4.8% should be the market clearing level of security. Okay? That's what this means. Okay? All right. In your note, you don't have this slide. I did not include in your note because this is from your textbook. Okay? And what this slide is about is simply pointing out that different types of securities have different rate of return or required rate of return. Okay? And of course, that depends on the risk level, right? So, which security has the lowest required rate of return? Of course, the one with the minimum or least risk, right? Which security has the least amount of risk, right? You can say the short-term government debt, like a U.S. government treasury bill, like 3 months treasury bill, right? And you can say there's almost no chance that U.S. government will go bankrupt in 3 months, right? So you can say we consider that the risk-free rate, okay? And then as we move on to the longer-term security, right? Even the government debt becomes it involves some risk, right? No, you never know what's going to happen in 20 years, right? Even to the U.S. government, okay? And then after that, you have high-quality corporate debt, like AAA or AA corporate debt, right? Corporate bonds, right? And right after that, you have high quality preferred stock. Okay? Preferred stock, you know the nature of preferred stock, right? It is not a debt. It is security. Formally, it's not a debt security, right? But in many senses, it is considered a debt, because when a company issued the preferred stock, they promise to make dividend payments every period. Right? So why is it riskier than the bond then? Well, that's the same thing with the bond, isn't it? Well, you're talking about liquidation, right? Liquidation of the asset, right? And it is true that bondholders has a little bit, they has a little higher priority than the preferred stockholders, right? But usually, when a company goes bankrupt, right, there isn't much to recover, right? So it's highly unrealistic to expect to recover your investment if the company goes bankrupt, right? But the thing is, the big difference between the debt and the preferred stock is that you are obligated to make the payment every period, usually every 6 months, right? If you miss one payment, the bond will be immediately ranked as D, default, right? That's a big problem for the company, right? But as far as preferred stock goes, right, you can, if the company's financial situation is not very good, then you can skip the payment, skip the dividend payment, right? Well, the thing is those skipped payments accumulate, right? So at some point in time in the future, you have to pay all those back, right? But at least you can skip some dividend payments, right? So that's the difference, right? And that's why it is considered a little bit riskier than the bond, corporate bond, okay? And then right after that, you have low quality, high risk corporate debt. What do we call those? Low quality, high risk corporate bonds? Huh? Junk bonds, right? Yeah. It's called junk bonds. Yeah? Well, junk bond doesn't mean it's trash, right? It's still good investment, right? If you want high return, right? The thing is, you have to take higher risk, right? So if you want quick return, quick money, right? Then you have to invest in junk bond, right? And then finally we have common stock. Common stock is considered the riskiest, right? Highest risk, the security, right? Because, well, companies are not obligated to make dividend payments, right? They don't have to pay anything on dividend, right? For whatever, for forever, right? And if the company goes bankrupt, you don't get anything, right? So that's the stock, the nature of common stock, right? Okay. All right, so the next topic, a few slides, are about the component costs of capital. How do you calculate the component cost of, the cost of each component of capital, right? So starting from the debt here, right? Marginal cost should be compared to the marginal benefit of an investment. Right? It's always the same thing. We talk about the marginal cost to the marginal benefit instead of comparing the total cost to the total benefit, right? You understand that concept, right? Marginal cost. What's important is marginal cost and marginal return or marginal revenue or marginal benefit. Right? Well, typically, when a company tries to come up with the cost of capital, they're thinking about the new investment, right? Or additional investment. Okay? So it's only natural to think about the cost of additional capital. That's what we mean by marginal cost. Okay? If you want to get some extra capital from now on, right? How much does it cost? Okay? We're not talking about the cost of your accumulated capital in the past. Right? So total cost doesn't matter. Right? What matters is marginal cost. Right? You need $100 million additional capital. How much does it cost? Right? Doesn't matter how much money how much asset you already accumulated, and let's say you were able to accumulate all this capital at, say, 3%, right? But that's irrelevant, right? What matters is what's the cost of your additional capital from now on, right? If it's 7%, well, that's probably too high, right, to consider this new project, right? So you have to consider the marginal cost to the marginal benefit of an investment. Okay? Cost of debt, we already talked about it here, right? So how do you reconcile this? I mean, obviously we are talking about the internal rate of return concept here, right? The pre-tax cost of debt, KD, we're talking about this discount rate here, right, is based on the net proceeds, price net of issuing new bonds. Okay? So here, it's slightly different from what I've talked about here, right? In the previous discussion of bond, right, we were on the side of investor, right? If you were an investor, right, when you purchase the bond, you pay a certain amount of money, right, and you receive interest payments, and when the bond matures, you get $1,000 back, right? We're talking about that point of view, right? Here, we're talking about we are issuing the bond. Okay? So instead of paying the initial price, we are receiving. Okay? It's called the proceed. Okay? So when you issue the bond, how much money can you receive from this bond? I mean, par value is typically $1,000, right? But that doesn't mean you will receive exactly $1,000 by selling the bond, right? As you know, in most cases, bonds are sold at discount. Okay? Especially the government bonds are sold at very high discount many times. Okay? So this is the proceed, net proceed. Right? So we're talking about this, what we call spread. What's spread? Spread. Spread is the difference between what the investors pay and what the company receives, right? Investors may pay $900, but the company may receive only $850. That's the net proceed, right? So the difference, $50, is called the spread. What happens to this spread? Investment bankers keep, right, this spread. That's how they make money, right? Investment bankers, right? Okay, so that's a fee basically, right? Service fee for their, the advice and actual work, right? Okay, so from the point of view of issuer, right? you have received $850. That's the net proceed. Okay? And then every period you pay, instead of receiving interest payment, now you're paying interest payment, right? And at the maturity, right, 10 years later, 20 years later, you have to pay back the principal, right, which is par value, right? So that's what we're talking about, right? So considering the net proceed and amount of cash flow, we're talking about outflow of cash instead of inflow, right? And the actual maturity payment you're going to make at the maturity, right? We can calculate the internal rate of return, right? We did that in calculator, right? It's pretty simple, right? And we'll do that later, okay? So we're talking about internal rate of return here, right? But previously I told you that the cost of debt is determined in the market, didn't I? So how do you reconcile those two different ideas? Will they be the same? Your internal rate of return that you calculated and the market clearing rate, right? Will they necessarily be the same? Do you understand what I'm asking? Right? If you go back to the previous slide here, it says the cost of capital is equal to the equilibrium rate or market clearing rate of return demanded by investors, right? But here I'm giving you a different idea, right? The rate of return on debt is calculated using this equation, yeah, as an internal rate of return. So which one is correct? Any idea? Answer is they will be the same. They will have to be the same. Why? How come? Who determines this price? EMV? Oh, NINV? Yeah, you can say they are the similar concept, right? But in this context, it's kind of reversed here. You are selling the bond, right? And you are receiving this amount of money. In my example, $850, right? So who determined this $850? Why couldn't you get more? Market. That's right. Okay? So as a result of the market condition, demand and supply for your bond, for the same type of bond you're selling, right? This was imposed on you. In other words, that's the market clearing price, right? So if you calculate this internal rate of return based on the market price, it's the same thing, right? That's the market clearing rate of return. You understand what I'm telling you? Okay? Yeah, so we are talking about the same consistent concept here. Okay? After-tax cost of debt is the relevant cost. Yes. So as far as the debt, cost of debt is involved, right? because the interest payments on debt is tax deductible, right? So once you calculate KD, you have to multiply 1 minus T, okay, to calculate the after-tax cost of debt. Okay? Okay? A little more. Okay, here the pre-tax cost of debt can be estimated using. So pre-tax cost is what we're talking about, KD. KD, right? And if you multiply 1 minus T, I think in our textbook they call it KI. So this is the after-tax cost of debt. This is pre-tax cost of debt, right? That KD can be estimated using the yield to maturity of outstanding bonds. So what we're talking about here, right? Think about the situation here. You're trying to start a new project, okay? And you have to decide whether you're going to accept or reject this new project, right? And then what you need is this internal rate of return to make that decision, right? The problem is you don't know the internal rate of return until you actually try to sell this bond and see how the market determines the price, right? So there is a little bit of this timing problem. Okay? Timing problem, again, is you want to make the decision whether you're going to accept or reject the project, right? But in order to do that, you need to know the cost of capital, right? And you can calculate the internal rate of return. You can calculate the future cash flow, right? But in order to calculate the internal rate of return, you need to know this left-hand side, right? But you won't know the left-hand side until you actually try to offer this bond, right? So how do you know? How do you know the cost of capital in advance? Well, you can use the yield to maturity of outstanding bonds, right? If your company currently has outstanding bonds, okay, then, market already knows about your company, right? What kind of risk your company involves, okay? What kind of return your company generates, okay? So based on that, you can expect that the market will treat your company the same way as they did before, right? So you can consider the current yield to maturity. Yield to maturity is the same thing as IRR, you know that, right? This KD is the yield to maturity, right? In that case, this price is the price you paid, right, when you purchased this bond, right? Again, if you paid, say, $850 and received certain amount of interest payment and maturity payment, and you can calculate the yield to maturity, which is internal rate of return, right? So that's one way to determine the cost of debt, pre-tax cost of debt, right? In case you don't have any outstanding bonds, okay? And this is the first time you're trying to offer the bond in the market, right? Then how do you come up with this rate? Well, you have no choice. You have to use the pre-tax cost of debt recently sold by similar risk firms. Okay? It's like surrogate idea. Right? We talked about the surrogate firm to calculate the beta, right? Last class. Right? So you try to find the company which is very similar to your company, right? At least similar risk level, right? And see what interest rate they pay on their bonds, right? And then you can probably use the same rate, okay, to come up with the cost of capital. Question? All right, I will continue on Thursday. Okay?